very quickly, just a little bit more colour on who we are at Carbon Tracker. We're quite a unique organisation. I mean, yes, we're an NGO, but we style ourselves as a think tank. We do the sort of research a think tank would do. We're not for profit. We're mission driven. You know, we have a vision, which is a climate secure global energy system by 2050. And our tool, if you like, towards that is to align climate risk with financial market risk and opportunity, and demonstrate through robust financial analysis that there is real financial risk here if you continue down a business as usual pathway. And actually there's real financial opportunity if you grasp the transition that's now underway. But what I think is quite unique about us as an organisation is not-for-profit, philanthropically funded, but we're all former financial market professionals. So I'm, as you heard, a former corporate lawyer, with sort of track record in major law firms and investment institutions. But the engine room of Carbon Tracker is 8 or 9 former investment bank analysts, ex-HSBC, Citi, Barclays, and it is numbers that we work with. So yes, we do advocate for our mission, but we don't do or say anything unless it is very much embedded firmly in the numbers and in the financial analysis. And I'll give you a little anecdotal story as to why that's really important. When we launched our coal report back in September 2014, we did a financial analysis of the state of health of the entire global coal industry. First time anyone had really tried to do that on a global basis. The Minerals Council of Australia didn't like what we were going to say and what we were going to do, and they leaked a copy of our report to a friendly journalist of theirs at the Australian newspaper. If anyone has any experience of Australia, you'll know how concerned the Australian newspaper is to combat climate change and deal with climate change. It's probably one of the most climate skeptical publications out there. They ran basically a half-page story on us, which I'll summarise as climate activists pretending to be financial analysts. Now, if you have a career as a financial analyst, and everyone does, there's 2 places that you live to have your work written up in. It's the FT Lex column and The Economist. Now, the editor of FT Lex saw this article, went, this is interesting. Let my team look at that, crawled all over our analysis, and went, God, this is a really good piece of financial analysis of the global coal industry. We got pretty much the entire FT Lex column that week, and the following week we got it written up in The Economist. So thank you very much, Minerals Council of Australia. But the moral of that is the financial analysis has to be robust. And ours, it is very important that it is. Because we're out there talking to the financial institutions, the asset managers, the pension funds, the investment bankers, the pension consultants, the advisors, the pension trustees, explaining why they need to start, why they cannot be asleep at the wheel in respect to the companies that they own, because if they do, there are going to be financial implications that they may not like. Now, you've probably heard, various talks about the Paris Agreement. I'm not going to go into it in any great detail, but we have a global agreement, and it sets out a level of ambition. So leaving aside all the debates about whether it's top-down or bottom-up or how legally robust it is, the governments of the world have said we need to endeavour to keep global average temperatures at or below 2 degrees, and preferably go further if we can to 1.5 degrees to deliver a stable climate. And that is a very clear signal to the financial markets that that is the intention of governments. Now, we all know governments put out all kinds of policy intentions, and they don't always robustly keep to them. But you generally know the sense of direction, and we've got a very clear signal here. But I think what's really important to understand is, of course, 5 years before we had a massive failure at Copenhagen. And what you need to understand is the difference. There was a number of things. One, those steering the process, Christiana Figueres and others, understood that we weren't going to get this top-down, all singing, all dancing, legally robust agreement. So you needed something that was more of a framework, bottom-up, where countries could decide the level of commitment they put forward, and that's the nationally determined commitments, INDCs. But also the political leaders who signed up to this understood the world changed dramatically between 2009 and 2015. The technology, effectively the way we're going to deliver that 2 degrees target and those emissions reductions, reached a level of maturity and a level of cost whereby the political leaders could actually say, yes, actually, we now have the tools. We can see how we're going to do this in a way they couldn't see in 2009. And I like to say that, in effect, the technology moved into the driving seat, and the policy now is all about speeding up that implementation of the technology. That's what made it politically possible. I think the other thing to understand for the biggest energy companies in the world is if we meet the INDCs, and again, you've probably heard from others, and you will hear in other talks, that the INDCs are a level of ambition, but even if they're fully implemented, they still will not get us to 2 degrees, probably 2.5, 2.7 degrees, maybe 3 degrees. So we're going to need some ratcheting up. But even if we meet the INDCs, that implies a drop in demand for fossil fuels on aggregate, oil, gas, and coal, of 10% by 2030. Yet, if you look at all the demand forecasts coming out of all of the oil, gas, and coal companies, they're projecting massive growth in demand for their products, around 20, 30, 40% by 2030 and 2040. So there's a disconnect there, clearly. And how do you square that? And who's right? Because a lot of money will be made or lost on the basis of who's right on this. And that's why the financial analysis of this situation is so important, and understanding actually the assumptions on which those demand forecasts are built, and we'll look into that. But let's come back to the basic concept. I think what was so exciting about what Carbon Tracker did, I'll describe it, we've heard it described, I'll describe it in a different way. For any of us who've been involved over the last few decades in environment or climate advocacy, or anyone who cares about this, the first thing, and it took me, bloody 2 decades to realize this, we're weird. If you care about this stuff, you're actually quite weird to the majority of the population, because you're thinking about things in way, 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 way into the future. I mean, I'm talking about 5, 10 years, rather than the next 12 months. And I know this, even very highly educated financial market professionals. Most of my former partners, even not just my former partners, but lawyers, just trying to get most of them to think about anything beyond their next billable target in the next 12 months, even trying to get them to think about the following financial year and marketing for that year was a struggle, let alone starting to say, well, we've got this big problem called climate change, and in 5 years, and in 10 years, and in 15 years, very difficult. So, and the problem is, most of us who care about this stuff, we're so passionate and we're probably very geeky, we talk at our audience about what we care about in our own language. What we don't do is sit there and go, actually, what does the vast majority of the population care about? Okay, so how do I communicate this problem to them in terms of what they care about and in their language? And I think that in terms of Carbon Tracker, this was the genius of Carbon Tracker, by design or accident. Its audience being the financial markets, financial market professionals. Generally, what does a financial market professional care about every day they go in? It generally boils down to risk and reward in terms of investment decisions. What's the risk here if I put my capital into this, and what's the reward that I will get for taking that risk with this money? And that's really what it boils down to. So you've got to talk to them in terms of risk and reward around investment decisions, and you've got to talk to them in their language, financial language. And this, in a sense, is what Carbon Tracker did. So it took, and as we said, a key piece of the science, the carbon budget. And so just to sort of describe, we've got a target of 2 degrees. Well, what does that mean? Well, the scientists have told us what that means. It means if you want to keep below 2 degrees, or in fact, let's talk about in probabilities, because it's not absolute. So if you want a 50% probability of keeping average global warming below 2 degrees, you can put about 2 trillion tons of carbon into the atmosphere against a pre-industrial level. The bad news is we've done half of that, and we've got about 900 gigatons left. So what Carbon Tracker did, or my colleagues did back in 2011, is they said, okay, well that's interesting, but that doesn't mean anything to your average asset manager or investment banker when he goes into the office every day. So how do you translate that into something that means something to a financial market professional in his day-to-day job? They said, well, how do you relate that to real-world assets? Well, they said, okay, well, the biggest part of the problem is energy. Okay. So how much carbon is locked up in all of the oil, gas, and coal reserves and resources out to 2050? So again, back of the envelope calculation, which is not that difficult to do, and worked out that it's nearly 3,000 gigatons. If we want a 50% probability of staying below 2 degrees, we can only put 900 gigatons into the atmosphere. So if the oil, gas, and coal companies continue business as usual over the next 30 years, and they explore, exploit, develop, and we burn all of that oil, gas, and coal, we've got a big problem. And because warming is not linear, we're not going to sort of 2 degrees or 2.5 or 3 degrees. You're probably going to 5 or 6 degrees several times over if we were to burn all of that over the next 30 years. So we can't. But it's just a massive disconnect between the two. So we've got, a vast majority of the oil, gas, and coal reserves and resources upon which the future business models of these companies are based has to stay in the ground. And that's when you get the attention of asset managers and shareholders, because they go, ooh, well, I'm massively exposed to Shell and Exxon and Chevron and Peabody and BHP. God, and I've got to provide returns over the next 30 years to my customers who have invested in this pension. And they're my biggest dividend payers. Oh, okay, this is a problem. But how does that shake out? Now, the response we got was, that's all very well, Carbon Tracker, but that's a nice simple theory, and it is. It's very simple and easy for people to understand, but the devil's in the detail. And we said, well, yes, we agree. We know that we're not going to turn fossil fuels off overnight. This is a 30-year transition, so we are going to have to burn some of it, unless we want the lights to go out overnight. But we have to burn less and less of it. So what's a very logical, financially prudent way to approach this? So that's why we built the team of financial analysts, we bought the commercial data, and we started analysing all of the world's oil, gas, and coal projects. But, we have a problem. We've not got a lot of time. We've got to move quickly, because this is the speed at which we are consuming the carbon budget. At the current rates, we will probably burst through the 2 degrees budget, and that's the 50% probability budget, by the sort of mid-2030s, 2034, 2035. And of course now people are talking about, well, 2 degrees is far too dangerous, we should be trying to keep to 1.5 degrees. So this is not an easy problem to solve. And here's the trajectories that we've got to effectively bend down, and very quickly. So you see, on current policies, we're going to about 3.3, 3.9. Of course, with the uncertainties, it could be much higher. With the pledges, if fully implemented in the INDCs under the Paris Agreement, we may hit 2.5, 2.8 degrees. Which, of course, the scientists are telling us 2 degrees for a reason. They think anything above 2 degrees is far too dangerous for a variety of reasons. As I'm no longer a scientist, I don't have to explain all of that. What we've actually got to do is to get down on this trajectory to actually give us a chance of stabilizing. And we've got to start bending that curve down very quickly. So that's the challenge. Now, I was talking about technology. I think the good news is, as a species, we're fantastic. We are so creative. We change the world with technologies. And when these technologies get to tipping points, it happens very, very quickly. So here, this is a sort of little test for you. I promise you, there is a car in there somewhere in 1900s at the Easter Day Parade in New York, 1900. This is the same Easter Day parade in 1913, 13 years later. And again, there is a horse and carriage in there, but you don't know if you can spot it. That's 13 years. And that was in a time when technology didn't spread as quickly as it does now. So I think that, there is hope. And as I said, technology is in the driving seat. We are now in a technology-driven, low-carbon transition. There's no longer any doubt about who the winner is going to be. It is going to be clean technology. I think here's a more modern example. I mean, I do remember this stuff from 91, and I do remember in 91 it all looked really sort of high-tech and sophisticated. But, I mean, again, in a relatively short period of time, we're innovating, we are producing stuff that's unrecognizable to this stuff. So just imagine 25 years, 30 years from now. I mean, this stuff will look, iPhones will look as clunky, maybe, as that stuff. They may not even be using handheld phones anymore. Now, we just did a recent piece of research with Imperial where we updated the energy demand models. And what we found, we did a piece called Lost in Transition back in 2015, where we unpicked these energy demand models. Remember I said all of the oil and gas and coal companies are projecting this massive increase in demand for oil, gas and coal. We'll all be using much, much, much more by 2030 and 2040. When you unpick the assumptions across those models in the industry, you find that they take the highest projections, estimates, guesses of the future for GDP growth, population growth. But on the other hand, they take some of the most pessimistic assumptions for the growth of things like solar, energy storage, wind, growth of electric vehicles. So of course, what you get out of the end of those models is we're going to have huge growth in demand for fossil fuels. So when you actually take some more moderate set of assumptions, and the other thing we found when we went into these models is quite a lot of the models are using data or assumptions or prices for things like solar that are 3, 4, or 5 years out of date. So when you update the pricing, because of course the price of clean technology over the last 3 or 4 years has dropped dramatically, you get a very different answer. And that's what we had with our latest report, Expect the Unexpected. That actually growth for oil, gas and coal may not be anywhere near as much as the industry is predicting. And in fact, we may see much more massive growth in clean energy instead. So solar PV supplying 23% of global power by 2040 and 29% by 2050. Electric vehicles providing 35% of road transport by 2035 and over 66% by 2050, which would mean coal demand peaks as soon as 2020, oil demand peaks as soon as 2020, and we see gas demand curtailed. So still a bit of growth, but nowhere near as much as the industry is predicting. But the oil, gas and coal companies have been committing billions, potentially trillions of capital expenditure on projects to meet these projections of future demand. But there's a lot of bits of evidence out there that this is not going well for them. I mean, return on capital for the big fossil fuel companies has not been great over the last 5 or 6 years. Their share prices have been heavily impacted. So their business models are under stress because the world is changing. But they are struggling to work out how to deal with that because this industry has been in growth phase for 80 or 90 years. It's in their DNA, it's in their psychology. They love to go out and do big, difficult, technical projects in the Arctic, tar sands, ultra-deep sea. And they're struggling with the fact that they have lost their monopoly on energy generation. And that's only going to go in one direction. And effectively, these new technologies are now competing with fossil fuels and they're destroying demand for their product. We did a piece called, a piece of analysis on this, the Dangerzone report, well, we actually, again, we went through every single oil, gas and coal project, and we looked at the ones that were high risk because they are incredibly high cost. And what we also found is a high correlation between these high cost oil, gas and coal projects and high carbon. So there's a lovely sort of coming together of the projects that would release the most carbon also happen to be the most expensive and the most risky from an investment perspective. So it gives you a logical place to start if you want to start winding back the fossil fuel industry year on year over the next 30 years. And a very logical way to do it. And again, you can also identify, as we've done, exactly where those potentially risky climate projects, but also risky financial projects are. And this is happening already. A loss of just 10% in market share for coal led to a collapse of the US coal sector over 5 years. The share price of most listed US coal companies collapsed 90 to 95% over a 5-year period. Over 30 of these companies went into bankruptcy. So it doesn't actually take a big shift in demand to have a massive financial impact on these huge companies. Just to put that in perspective in terms of oil, 2 years ago, when the current oil situation arose, it was a 2% increase in global supply of oil that led the oil price to collapse from $120, $130 to around $30 at its lowest point. It's around the sort of 50, 55 mark now. So again, the business models of these companies are quite finely tuned to demand for their product. And it doesn't take a massive shift in demand for the product to actually have a massive financial impact on the companies. Now, of course, the problem is, if this capital is deployed and effectively the capital is lost, it is destroyed in projects that become stranded assets, don't provide a return, that capital is no longer available to be used elsewhere. Now, of course, the shareholders could use it in anything, retail, property development, but of course they could also use it to invest in clean technology. But if that value has been destroyed, it is no longer available to be used in these other investments. So it is a very important issue. I mean, also interestingly, if this transition is not managed well, it's ordinary people who will suffer. I mean, already, because of Peabody's bankruptcy, the employees of Peabody, people who depend on the company and its pension fund, are at risk in terms of their future retirement. So, this is also, if we manage the transition properly, value doesn't have to get destroyed. The employees of these companies don't have to lose their retirement savings. And what we're also seeing is, there are lots of plans around the world to build new coal-fired power stations. But again, when you start to scratch the surface and do a reasonably robust financial analysis of these projects, again, the economics do not stack up. They don't make financial sense. And of course, geography doesn't help. Many of the countries trying to build coal-fired power stations actually don't have their own coal supplies. Yet if they were to move to clean energy, they have their own sunlight and they have their own wind. There was a recent report, which I think was not from Carbon Tracker, but I can't remember who it was from, but said clean energy, renewables, gives every country in the world the opportunity to have its own North Sea oil reserve. Because everybody has sun and wind to a greater or lesser degree. So everybody has their own natural energy resource and doesn't have to rely on the sort of lottery of whether you've got coal, oil, or gas reserves. Now, just to sort of do a little bit of the digging into how we have worked, is we started this whole process of the deep dives and trying to understand the economics of individual projects by creating something called a carbon supply cost curve. If anyone's done any financial analysis, you will know that in the financial markets, the cost curve is the kind of workhorse of any analyst. But we combined that with carbon intensity. So we thought, okay, we want to understand the carbon intensity of projects and the financial break-evens of projects. And as I said, we found quite a high correlation. We started that with the oil industry. So we bought the Rystad data that the investment banks and the companies themselves use, and we analysed all of the projects. And it surprised us when we did that first oil supply cost curve. That was April 2014. The oil price was about $120. It was a few months before the collapse. And our analysts concluded a number of things. When they did their demand analysis and really dug into demand and what was really happening out there, they could not understand why we had an oil price of $120. And that's what we said, and everyone laughed at us. In fact, I remember at the launch, the head of oil and gas from one of the big investment banks in London came up to me and said, "What are you guys smoking? You know, don't you realize the days of sub-$100 oil are over forever?" Gives you an idea of how the financial markets work. But we broke the curve down into 3 sections. Because we thought the long-term equilibrium, we think it probably still is, $60 to $70, maybe $80. We said, okay, the fundamentals suggest that's the long-term oil price. So we looked at all of the projects above, and there was a lot of oil projects going ahead that would require break-evens above $70, $80, $100, $120, some as high as $150. There were even some projects that would never break even unless you had an oil price of $200 a barrel. And we started going, well, what's going on? How are these companies getting away with sanctioning projects that require such a high oil price to ever make any money? Surely that's destroying value in the company. And then we also looked at the oil we would need to keep within the 2 degrees budget. That was below the $60 break-even. And what was also interesting there is 80% of that sits in Saudi Arabia and the UAE. So sort of maybe understand some of the logics of what's happened over the last 2 years, a little bit of the logic. The difficult bit is all of this oil in here, because of course that will make some money. Obviously not as much as this, but it's still viable if we're right about the long-term equilibrium oil price. But then, trying to predict the oil price is a mug's game, as our analysts say, so it's quite a dangerous thing to do. But the point is, what we found is no real oversight on the companies, or a lack of capital discipline, and shareholders effectively asleep at the wheel, who believe in anything the oil and gas companies told them. And oil and gas companies who would rather go out and do massively expensive projects to maintain their reserves than actually look at them and decide whether these made financial sense and apply very robust capital discipline to the projects they did. But we're now seeing the results. Companies are now pulling out of many of these high-cost projects as we see a sustained lower oil price. ExxonMobil has recently written down 19% of its reserves as the giant oil sands project Kearl becomes uneconomic. Doesn't really tell you the billions that they've poured into that over the last few years. In fact, our report warned in 2014 that that project didn't make financial sense, but it's taken them a few years to actually do anything about it. Now this is, again, coming back, remember I talked about demand and the assumptions. So we've taken the forecast for the growth of solar from a series of the IEA's World Energy Outlook reports as a proxy for all of the energy demand reports that have come out from the industry over the last few years. These lines represent their predictions for the growth of solar. And this line up here is what's actually happened. You can see how good or not good they are at actually predicting what's actually going to happen. This is the sort of basic methodology that we used and the different scenarios that we ran in the recent report. So we ran a series of policy projections. Cancun, very weak policy. Effectively, we use a proxy carbon price. So we convert all policies into a proxy carbon price. So Cancun is effectively zero. Weak sort of global climate policy, $10 a ton. The NDCs is around 30, so if they're fully implemented, and a strong set of global climate policy about $50, which is the one you really need to drive the 2 degrees transition. We also looked at technology costs, and as I said, we updated a lot of those from the original, the technology costs for things like solar, wind, etc., that are in a lot of the demand models now, to the sort of lower costs that we think we are seeing and we think we're going to see. And then again, we took the sort of high forecast for energy demand and then the low ones that we think are more likely, more realistic based on the assumptions. And we ran those different scenarios to get the results for the unexpected. And again, as I say, what you see is that quite dramatic. And you can play around, you can go on, there's a dynamic model on our website, you can go in and you can play around with this, which is quite interesting with some of those different scenarios. So you see solar PV could literally replace coal by 2050. I mean, 30 years is not long in terms of that type of restructuring of something that's so fundamental to our economies and civilization. Climate policy kills coal. New solar PV cost trajectory results in strong growth. Uncertainty around future gas demand, which is, again, many of the big oil and gas companies have staked their future, sort of climate future on gas, but even that past 2030 begins to look quite risky. And CCS, carbon capture and storage, is effectively leapfrogged. We just don't need it, certainly not for energy. So all of the billions that are now being poured into trying to get pilot CCS projects off the ground, it's all a waste of money. It sort of reminds me of, I think, around the turn of the 20th century, the big concern was cities getting swamped in horse dung. And I suspect there were lots of people working on solutions to horse dung, but that problem kind of got supplanted by the automobile. And a third of all vehicles could be electric by 2035. So much stronger growth than is being predicted by industry. But I think what's quite exciting about this is even in the Trump scenario of weak global climate policy, the technological genie is out of the bag. This technological transition is happening. As I said, the winner is clear, even if we get weaker policy. The problem with that, though, so because the winner's clear, so it's no longer a case of if, but it is a case of when. Remember the clock we showed at the beginning of how quickly we're burning through the budget? That's the problem. That we have to drive this technological transition faster to beat the clock. We've never really had that problem in technological transitions in the past. There wasn't this sort of overarching threat to the climate or anything else that we were racing against. So the question is, how do you bring that finishing line closer? But I think psychologically, it is important that we know the winner is now clear. So you're backing the winner. There's no question about that. You just want the winner to get across the finishing line more quickly. And you don't want to destroy value doing so. Certainly for people at my age, that's quite important because so much of our pensions is tied up in that value that could get destroyed. I think what's also exciting is for any of us who've been involved in carbon markets, as I have before I was a carbon tracker, is what is actually needed is not as high as was once thought. I mean, even as recently as 5 years ago, the common sort of wisdom is that we needed a price of at least $100 a tonne to drive this transition. When we run this model, it's quite clear that the carbon price now needed, because the technological solutions have come down so dramatically, so unexpectedly and so dramatically in cost, the actual carbon price needed to get us on that pathway is a lot lower, about $50 a tonne. And that probably will come down even more over the next few years. So politically, it should be easier to implement a carbon price, because that now doesn't sound so horrendous as a $100 a tonne price. I think in Europe for several years we had a price of around 30 euros and the world didn't stop. Industry didn't go bankrupt. So we probably could easily survive a $50 euro or dollar a ton price without any of the problems that industry would tell you they're going to face. I think what's also exciting is, I think was it Churchill who said this is not the sort of end of the beginning, or it's the beginning of the end, something like that anyway. But this is...
We've arrived at the end of the beginning.
We arrived at the end of the beginning, exactly. But we are at the beginning of the end of the fossil fuel era. It's quite clear. We sort of call this the twin peaks of demand for coal and oil, and a plateau for gas. So this is now going to be a declining industry. And that's a really important message to get out there in all kinds of scenarios. To investors, change their mindset. It should no longer be the default that, fossil fuel project, I'm going to make money. Or for a country that's going to bank its whole future development on those oil, gas, or coal reserves and pour huge amounts of their own money and development money into those projects. It would be far better pouring that money into clean technology that's going to be less expensive. And similarly, we're already seeing, we did a piece of energy access analysis that tells us for the vast majority of the world's energy poor, clean energy is now the cheaper solution. Because the vast majority of the world's energy poor do not live anywhere near an urban centre, and therefore they do not live anywhere near an existing grid structure. So you don't, with clean energy solutions, you don't have to build an expensive grid. If you want to bring them coal-fired power, you'd have to build the grid and the transmission lines and everything else, and that will be horrendously expensive. So this, I think, is another important tipping point. And of course, the counterintuitive thing here, and we suspected this for a long time, and we did a piece of analysis on this, and we found that there is a very strong case that if you put the world's oil, gas, and coal projects on a 2 degrees pathway, which means going ex-growth, remember, which is going to be psychologically difficult for them, but if you put them on an ex-growth pathway, there's still a very lucrative business for them for the next 3 to 4 decades, making a lot of money out of the reserves they've already got and are producing to provide the energy that the fossil fuel energy we need as we transition to a clean future. But they wouldn't be wasting money, the revenues they make from that existing oil, gas, and coal, in ever more expensive and difficult projects. They could be returning that to shareholders or investing it in clean energy. We don't really care which. So they could actually be worth more. There's a very strong financial case that these companies could be worth more in terms of share price and ability to pay dividend if they go ex-growth and start contracting. And again, that's a very important message to get out there to their shareholders and to the financial institutions. And to get the shareholders and financial institutions to also understand that if they don't do this, and they continue in that growth mindset, there's a very strong chance that will result in a destruction of share value, and therefore the value of the investment for the pension funds and asset managers and other investors. And we came to the conclusion that the 7 oil majors could be collectively worth at least 100 billion more by focusing on their low-cost, lower-carbon production. Now, what we're seeing with this technological transition, it's nothing new. We've been here again and again and again, not in the context of climate change, admittedly, but technological transitions. And there's a lot of evidence out there in the business literature to show that incumbents almost rarely survive these technological transitions. Doesn't matter how long they've been around, doesn't matter how big they are, how politically well connected, actually how big their bank balance is. I mean, yes, they can spend a lot of money and they will probably delay the transition with their lobbying. The rail industry did that until finally the tipping point came and it was clear to government that the automobile was the winner, and of course then governments flipped their support to the automobile. We've seen that with photography, Kodak, digital, typewriters, laptops, and so on. I mean, If that was not the case, this laptop would probably be manufactured by someone who used to manufacture typewriters, Olivetti. The camera in my smartphone would probably be manufactured by Kodak. The cars you do or don't now drive, younger people don't now drive cars as much as older people, just don't need to anymore. But the car you drive would probably be manufactured by the people who used to manufacture steam locomotives. But none of that's the case. One of my favorite speeches is a speech given by the chairman of Baldwin. So if you'd been around late 19th century, early 20th century, and you've been involved, had anything to do with the financial markets, you know Baldwin, they were one of the biggest manufacturers of steam locomotives, I think the American Steam Locomotive Company. And they were massive in terms of shares and bonds and in the financial markets. Now their chairman made a speech on Wall Street to defend the millions they were then spending on the next generation of super efficient steam locomotives. And he said, "Mark my words, steam locomotion will be the dominant form of transport until well into the 1980s and beyond. And this automobile thing, now this will just be a little plaything for the rich and famous. It'll never catch on." Now, one of the reasons he was forced to make that speech, in terms of the money they'd invested in steam locomotion, was because that year 2 technological upstarts had just entered the Dow Jones for the first time, I think called General Motors and Ford. You know, and the rest is history, as they say. I mean, the really big question is history going to repeat itself with the oil majors now? And I think what's difficult, we engaged with them a lot. They know they have a problem. But what becomes clear is they really don't know how to deal with this problem. And when you know you have a problem, but you don't know how to deal with it, human nature means you just carry on doing what you did every day and just hoping things will be all right. But generally, they're not. And the analysis is stacking up that clean energy is, or is becoming, the cheapest power source today. We are reaching that tipping point that we've seen before with digital photography and with mobile communications and with the automobile, when enough components, technological components and policy components come together, that you get a technological takeoff. The good news is that financial regulators are now taking notice of this and seeing the risk. And Mark Carney, Governor of the Bank of England, has stepped in the last couple of years, and he's made a number of speeches about the risk, you know, and he's talked about this, the abrupt transition to a low-carbon future is a financial stability risk. And he's taken this so seriously as chair of the G20 Financial Stability Board, he set up a whole task force, climate risk task force, to look at this and look at the sort of disclosures that all companies should make on how exposed they are to climate risk and this transition. And that task force has made its recommendations. They're out for consultation at the moment. We're pleased that one of our key asks, recommendations, something we have campaigned for over the last couple of years, that all companies should do a 2 degrees stress test of their business model against objective scenarios, is a key part of those recommendations. Because what is, in my mind, crazy, when everybody's talking about climate change and the transition, is that very few companies are actually stress testing their business model against this technological transition or the impacts of climate change if we actually don't solve climate change. So if these recommendations come in, the mandate is voluntary, but more and more governments are talking about making them mandatory, they would be forced to start stress testing their business models against a low carbon transition and against the impacts of climate change. And that's very important, because once people are forced to think about that and the impacts, they're more likely to actually start doing something about it and working out what they do, instead of just ignoring this difficult problem they can't really get their heads around, and it's all a bit difficult. Again, I can only imagine when Kodak took the decision to sell off its digital photography division, there was a similar sort of process going on, and it's all too difficult, and it's not making anywhere near as much money as cameras or Kodak film, and we don't really want to worry about that for the next 2 or 3 years. So of course, when the takeoff came with digital photography, Kodak was nowhere. And as I said, the evidence is there is really no excuse anymore. You've got major financial institutions doing the sort of analysis that we've done on stranded assets, on climate risk. You've got Citigroup and HSBC and Standard & Poor's, Towers Watson, the big pension consultants, MSCI. The reports are piling up. But still, a lot of people are ignoring this. Financial crisis. Did anyone watch? I watched it recently. I used this in a talk in Tromsø up in Norway in the Arctic Circle about a month or so back. And on the plane up there, someone had suggested I watch this, The Big Short. Has anyone watched that movie? And you'll remember, in that movie, they're there, well, there's more and more data coming out showing that these mortgages are crap, that the defaults on mortgages are starting to go through the roof. Yet the value of these bonds, based on these, and these guys are making big bets against it, but then they're going, but the value is still going up. The value is still going up, and 6 months later, the value is still going up, but the data was piling up that these underlying mortgages on which all of these mortgage bonds were based were crap. Yet, trying to get the vast majority of very intelligent, very smart people in the financial markets to take notice of that seemed to be impossible. And these guys, they were making these big bets because they could see it. And they were making these big bets, and they were getting margin calls on the bets they made, and they're having to borrow more money, and they were trying to hold in there, and they were going, my God, but we don't understand. And they were going around telling everybody as loudly as they could, but still no one would listen. It's a great film to watch. If you have any belief that the markets are perfect, you should go and watch that movie. And I guess that is the big question we have to ask here. We're telling them, the data's there, we can see that we're in a transition, we can see that at the beginning of the end of the fossil fuel era, we can see that many of the projects, oil, gas and coal projects, that companies want to invest in don't make financial sense, yet they're still doing it. And you have to ask that question, are they listening? And what's going to happen if they continue not to listen? We're going to have a disruptive transition rather than a smooth transition. And that's very frustrating because we have the opportunity for a smooth, managed transition. But we're not going to have that if we continue to ignore all of the evidence and the numbers. This is numbers-based. This is financial analysis and evidence that there is a transition happening and there is real risk here, and that a significant amount of the projects on which these companies are based and their business models don't make financial sense anymore. But it seems to be a little bit like a huge supertanker, I guess that analogy is apt, isn't it? Trying to turn it and trying to get them to take notice is a challenge, no matter how much hard data and hard financial analysis you bring out. Thank you very much.